China has just locked the vault. Gold has physically vanished from American shelves at $4,500 an ounce. And the biggest bullion dealers in the US just admitted they are completely sold out of silver. Welcome to January 2026. While you are celebrating New Year's, the global financial system quietly broke. We have confirmation that Beijing has restricted silver exports, effectively choking the Western supply chain. The banks tried to crash the price on December 30th with a massive margin nuke, but it failed. The price didn't drop, it solidified. Experts are now projecting $100 silver within 90 days and $150 by year-end. If you are holding paper dollars, you are standing on a burning bridge. And today we expose the great squeeze that nobody is talking about. To truly understand the magnitude of this crisis, we have to look away from the manipulated charts on Wall Street and look at the forensic evidence from the ground level. We have analyzed a transcript from a veteran bullion dealer in the United States, a shop that has been operating for exactly 10 years as of this week. Their testimony provides a terrifying glimpse into the reality of the supply chain. Here is the situation on the ground as of the first week of January 2026. Gold is trading at over $4,500 an ounce. Just a few years ago, people said $2,000 was the ceiling. Now, at $4,500 plus heavy premiums, dealers are reporting zero inventory. The shop owner admitted that even at these historic highs, they cannot keep gold eagles or buffaloes in stock. If they manage to buy 4 or 5 coins from a walk-in customer, those coins are sold and gone within the hour. But the situation with silver is even more volatile. Silver has rallied an astounding 148% throughout 2025. We entered the new year with silver holding firmly above $70. To put that in perspective, just a year ago, the experts were calling for $28 silver. The dealers on the ground, however, saw this coming. They predicted $42, and the market blew past that to hit $72, and even spiked to $84 at the peak. What is happening right now is a phenomenon known as a liquidity squeeze. On December 30th, the COMEX, the primary futures exchange where the price of silver is supposedly discovered, executed a margin hike. This is a tactic used to flush out leverage. They raise the cash requirements to hold a contract, forcing traders to sell. The paper price flashed from $83 down to $70 in a matter of hours. The mainstream media called it a bubble bursting. They told you the rally was over. They told you to sell, but listen to what the dealers witnessed. When the price dropped on the screen, the physical buying didn't stop. It accelerated. The dealer noted that on New Year's Eve afternoon, while the paper price was bleeding, there was active buying. They bought everything they could. The shop owner confessed, "We were completely out. We were able to buy some later that morning, but it just doesn't stay." This is the critical signal. When the price drops and inventory vanishes, you are not in a bear market. You are in a bear trap. The whales, the high-net-worth individuals and the family offices, used that engineered crash on December 30th to sweep the floor. They took the last cheap silver off the market. The retail crowd, the average person, is still asleep. They think $70 is too expensive. They are waiting for a pullback to $50. They don't realize that $50 silver is gone forever. When the Chinese export ban fully bites in Q1, the price isn't going to $80. It's going to 3 digits. Now, we need to zoom out. We need to connect the dots between that empty shelf in Oregon and the geopolitical chessboard in Beijing and Moscow. Why is this happening now? Why has the supply chain suddenly snapped? This is what I call Operation Silverwall, the China connection for decades. The West has been comfortable letting China handle the dirty work of refining. We ship them the ore, they refine it, and they ship us back the .999 fine bars. It was a convenient arrangement. But on January 1st, 2026, the game changed. Intelligence reports confirm that Beijing has implemented a soft embargo. They haven't announced a total ban on CNN. They are smarter than that. They have implemented a new licensing regime for the export of strategic critical minerals, including refined silver. They are making it administratively impossible to get metal out of the country. You have to understand the leverage here. China controls between 60% and 70% of the world's refined silver capacity. They are the bottleneck. By tightening the screws on that bottleneck, they are creating a supply vacuum in the West. Why would they do this? Because they need the silver. The net zero trap. The United States and Europe have spent the last 5 years aggressively pushing a net zero 2030 agenda. They want to electrify everything. They want a solar panel on every roof, an electric vehicle in every driveway, and a 5G tower on every corner. Here is the fatal flaw in that plan. You cannot have a green revolution without silver. It is physically impossible. Silver is the most conductive metal on Earth. It is essential for solar photovoltaics. It is essential for EV circuitry, and it is essential for the AI chips that run the whole system. We are currently in a 6 to 7 year structural deficit. The Silver Institute's data confirms that. Since 2021, the world has consumed significantly more silver than it has mined. We have been eating into above-ground stockpiles. The vaults in London, LBMA, and New York COMEX have been drained to historical lows. Now, China has looked at the math. They see that the West is desperate for silver to build its military technology and its energy grid. So, they decided to keep the metal for themselves. They are weaponizing the supply chain. This is a perfect storm. You have declining mining yields, exploding industrial demand, and now, the primary refiner of the world, refusing to export. The Russian and BRICS factor. It's not just China. We must look at the BRICS alliance. Russia and China have completely stopped buying U.S. treasuries. They are no longer recycling their trade surpluses into American debt. Instead, they are buying hard assets. Russia has even proposed a separate precious metals exchange for the BRICS nations, one that would completely bypass the London and New York pricing mechanisms. They know that the COMEX price is fake. They know it is determined by paper contracts, not physical delivery. By hoarding physical metal, the East is preparing to break the Western pricing monopoly. The mining crisis, some of you might be asking. If the price is $70, why don't the miners just dig more up? This is the tragedy of the mining sector. You cannot print a silver mine. It takes, on average, 10 years to move a project from discovery to production. It involves permits, environmental studies, There has been an unwritten rule on Wall Street for the past 40 years. Silence on a Friday evening usually signifies settlement. Positions have been closed, risks have been hedged, and the bankers have left their offices to enjoy the weekend. But this weekend, that silence carries a completely different tone. It is the calm before a Category 5 storm. Last Friday, we witnessed a technical black swan event. According to the standard script, silver prices are always subjected to automated selling pressure during the final session of the week to crush the momentum of the bulls. But this time, that script was torn to shreds. Instead of collapsing, the market accelerated and closed at the absolute highs of the week, $67.14. Let that number sink into your trading psychology, $67.14. For the retail investor, this is good news, but for the risk management departments at the major bullion banks, this is a liquidity disaster. They are currently trapped with billions of dollars in net short positions that are deeply underwater while the market is closed. They are locked in a panic room with no exit for 48 hours. In today's deep dive report, we are going to dissect this event. We will analyze why this closing price is not just a number, but the fuse that will trigger a massive chain of margin calls come Monday morning. To understand the severity of this, we need to look at the market microstructure. When a market closes at the highs of the week, it sends an incredibly powerful signal. The buyers accepted market orders at any price, right down to the final seconds. This indicates that smart money currently fears the risk of not owning the asset more than they fear the price risk itself. Put yourself in the shoes of a market maker who is short silver in the $64 region. Their quantitative models predicted a drop to $60 so they could cover and take profit. But reality forced the price to $67.14. Their unrealized loss is currently sitting at over $3 per ounce on a volume of millions of ounces. But we must also address the elephant in the room, the options market and gamma exposure. At $67.14, we have pushed deep in the money, ITM, for a vast array of call options that were previously written off as worthless. This forces options dealers into a gamma squeeze. As the price rises,
Dealers, who must remain market neutral, are mathematically forced to buy more of the underlying futures to hedge their exposure. It becomes a feedback loop from hell for the shorts. They aren't just fighting the trend, they are fighting the mathematics of the derivatives market itself. Furthermore, we must anticipate the reaction of high-frequency trading algorithms. These black boxes thrive on momentum ignition. A gap opening above $67.14 will trigger automated buy programs before a single human trader has had their morning coffee. These algorithms do not care about valuation, they only care about velocity. They will pour fuel on the fire, exacerbating the move in milliseconds. And here is the fatal issue: variation margin. Typically, these losses are settled in cash at the end of the day, but Friday's price shock was too massive and too fast. It blew through the credit lines of many hedge funds. On Saturday morning, while the market was closed, margin calls were sent out. The demand is simple: post additional collateral before the Asian Open on Monday or face forced liquidation. And when a short fund faces forced liquidation, the computer system executes only one command: buy back at any price to close the position. This creates a classic short squeeze scenario. On Monday morning, we may not see buying power from natural demand, but buying power born from the panic of financial institutions trampling over each other to exit.
However, the financial story is just the tip of the iceberg. The submerged part, and the most dangerous part, lies in the dislocation between the paper market and the physical market. We are witnessing a record-breaking arbitrage spread. In New York, COMEX, silver is at $67.14, but in Shanghai, SGE, silver is trading around the $72 mark. A $5 spread in the commodities market is a massive figure. It creates a vacuum effect. Any silver bar that can be moved is being packed and shipped from London and New York to China. The West is suffering a physical liquidity drain. Why? Because industrial giants like Samsung or Tesla cannot operate production lines using futures contracts. They need real metal. They are executing off-market deals, securing supply directly from the mines, bypassing the COMEX entirely. Furthermore, we are hearing reports of a quiet run on the bank regarding unallocated accounts. For years, banks have sold paper claims on silver they do not fully possess, a fractional reserve system. But now, high-net-worth clients and family offices are demanding conversion to allocated status. They are asking for the serial numbers. They want the bars moved to a segregated shelf. This forces the banks to show their hand. If they don't have the metal, they must go into the open market and buy it immediately to satisfy the client and prevent a default event. This internal squeeze is invisible to the public, but it is the primary driver of the desperation we are seeing. The consequence? The spot price on your screen is slowly becoming a virtual reference. It no longer reflects the true cost to possess the physical metal. Registered inventory, metal that meets delivery standards, is depleting at an alarming rate. We are approaching 0 hour. When the Asian markets open, the most probable scenario is a gap up. The price could open directly at $68.50 or $69, skipping the intermediate levels entirely. However, as professional investors, we must keep a cool head. Extreme volatility always comes with risk. Here is the battle plan for the upcoming session: patience in the face of a gap up. If the market opens with a massive gap to the upside, do not FOMO. In theory, the price often tends to return to fill the gap to test demand. Watch the support zone at $67. Beware the shakeout. Understand that the institutions know the retail psychology. They may engineer a sharp, violent drop, a rug pull in the early hours to trigger stop losses and flush out weak hands. Do not mistake a liquidity flush for a trend reversal. Monitor the psychological level of $70. This is not just a round number, it is the last bastion of the bears. If the price decisively breaks $70, the technical model shifts to a parabolic state, vertical appreciation into the price discovery zone. Focus on real assets.
In an environment of elevated counterparty risk, holding physical positions is the optimal defensive measure. In conclusion, Friday's closing price of $67.14 is not the destination. It is the siren signaling the collapse of the old price control algorithms. The bank's liquidity nightmare is becoming a historic opportunity for investors who are prepared. I will continue to update you on capital flow developments as soon as the session begins. Thank you for